Okay, so welcome back to part 2 of this Q&A session. Based on my post, I said ask me your burning questions, I'll be happy to answer them. So I've completed part 1, you can go watch part 1, and this is part 2 where I address the rest of the questions. So the next question would be any thoughts on Facebook, FB, and the Apple iOS privacy changes and its significance? So am I concerned with Facebook? Not at all. So Facebook is one of my core positions which I have. It's a great company. And recently it's been really bashed because of the whistleblower complaints, the outage, the platforms were down. And of course, recently because Apple changed its privacy policy, so some of these social media apps are not able to track the people as well, and that affects the advertising, and that's why Snapchat really got whacked recently, right? Am I concerned with Facebook? Not at all, for a few reasons. Number one, Apple, by the way, only has a 14.1% market share of the global smartphone market. So even if Apple's going to screw the social media companies, it's only going to affect a small percentage of the people around the world. But more so, it's going to affect the smaller players. For the bigger players like Google and Facebook, I don't worry about them at all. In fact, Facebook is now building basically their own devices. They are working with Ray-Bans to build their metaverse, and I think eventually they're gonna really focus on that, and they're gonna find a way to screw Apple back. So no worries about that. So from the charts, you can see that this recent set of bad news has allowed Facebook to retrace to its support levels. You can see a very strong support at the 200 moving average. We've got that wave up, we've got that wave down, and we've got these waves over here. And then recently we had this big correction all the way back to that 200 moving average, which is a pretty strong support. It bounced up and then Snap released bad earnings, so that gave some worry to social media companies. So it kind of like went back down again, but there's pretty strong support over there. Remains undervalued. The intrinsic value of Facebook's about 389. So at 324. It is undervalued, and you can see that earnings are coming up in a couple of days, so we'll see how it reacts to earnings. When you have a fundamentally strong company like Facebook with a brand monopoly and a strong network effect, you find that any kind of bad news is an opportunity to add shares. You can see over the last couple of years, every time they get hit by bad news, for example, the data scandal, the price drops, great time to add shares. The Cambridge Analytica scandal, price drop, great time to add shares. And if you just keep adding shares every time you get all this bad news, you make a lot of money on these great companies like Facebook. So the next question is on Tesla. Have you changed your stance on Tesla? It's gone up huge so far in 2020 and 2021. And the next question is about Evergrande, the China Evergrande situation. Is it going to overcome this turbulence? Will it affect the markets? Do you think it's a stock to buy? So let me answer the first question on Tesla. So I've mentioned many times before that Tesla is a stock that I would trade for short term. It's a swing trade using options, but it's not a stock I would invest in because trading is like a one-night stand. You don't really care about valuations that much. And if I wanted to trade Tesla, obviously I would like to enter on a wave down, the dip on the uptrend. So you can see from the stock, you can see the waves, right? Wave up, wave down, wave up, wave down, wave up, wave down. Now it's like wave up, right? So you always want to wait for a wave down before you enter a trade to catch the next wave up. Of course, if you're trading, you have to put a profit target and a stop loss. So sure, I would trade Tesla, probably using options, but it's not a stock I would invest in, right? There's a big difference. So again, trading is like a one-night stand. Investing is like you're getting married, right? You're holding the stock for the long run. And I won't do that with Tesla because number one of my rules is that I never invest in automotive companies, whether it's electric vehicles or whatever. Why? Because these companies tend to be in a very competitive industry. There's so many companies making vehicles, electric vehicles, right? So when you've got a very competitive industry, your profit margins are very thin, number one. Number two, it's a very, very high capital expenditure business, very high capex. So the company has to spend a lot of cash flow in manufacturing, building all these plants, and that sucks up the cash of the company. So I just don't like these kind of companies that use up a lot of cash, that have debt, and with low profit margins. Not my cup of tea. In addition, of course, Tesla is pretty overpriced. Now, Again, if you take a look at a quick valuation over here, and again, I'm just putting in their recent figures. Now, I'm using their net income, which is $3 billion. I'm not using free cash flow, because if you use free cash flow, it's like only $2 billion. So I'm being as optimistic as I can. I'm going to put 3.4 billion, and even at a 51% growth for the next 5 years, which is really optimistic, and tapering to a 15% growth for the next 5 years. And again, in the automotive industry, this is being really optimistic. Although you can argue that, hey, they are also into energy and all that. But even with these optimistic growth projections, the highest intrinsic value I can come up with is, 379, right? So at the current share price of, 910, I think it's way overpriced. Now, of course, it could go higher because remember, in the short term, share prices are driven not by logic, all right? In the short term, prices are driven by emotions, by sentiment, by manipulation. So sure, it could go higher, right? But it's not something I would dare to invest in, because I know it's only worth like $400 at the most, optimistically, all right? And it depends on your style, okay? To me, my number one rule in investing is to never lose money. I believe my primary objective is to never lose money. Making money is the secondary objective. So to me, I rather not make money if there's a chance of losing it. So I rather buy, Amazon and Alphabet and Google, which are undervalued, that have little or no competition, than Tesla, which is overvalued with a lot of potential competitors. And basically that's the way I think, right? So the next question would be on China Evergrande, which is the property developer. So the first question is that, would it create a financial crisis? The answer is no, it won't. It's all contained. Don't worry about it. In fact, I created a whole video on it. Go watch my video on Evergrande's so-called $300 billion debt default, which is a lot of misleading information from the media. All right, don't believe everything that you listen to. Now, would I invest in a company stock? Hell no. It's a lousy company. It's a broken company, right? In the first place, one of my rules is that I never invest in property development companies. For the same reason, I don't invest into auto manufacturers. Again, it's a very high capex business. It's a very cyclical business, very competitive. I don't like those businesses. And again, if you look at China Evergrande, it's hugely in debt, right? So I avoid companies with huge debt. It doesn't have consistent profits. The profits are very choppy. In fact, recently profits have been plummeting. So it's a lousy company. So remember that, one of the mistakes people make is that they buy a stock because it looks really cheap. Remember, cheap crap is still crap, okay? So no matter how cheap a stock is, if it's not a good business, I wouldn't touch it. All right, so let's take a look at these set of questions which are on investing strategy in general. So the first question would be, if you were given a large sum of money, would you invest it all right now or buy in stages, dollar cost averaging? And the answer is, you always buy in stages. You always buy over a period of time, dollar cost average. So one of my rules is that in investing, I only buy a good company when it is undervalued. So there are many times you find good companies, but they're not undervalued. You're going to be patient to wait for them to be undervalued, right? So for example, when it's like, 15% undervalued, I'll start buying shares, because 20% undervalued, I'll buy more shares. So I buy more and more, the cheaper it gets, then I get a better deal. And the thing is that you can't always predict the exact bottom of a correction. You can't always get the exact bottom. So you never buy all at once. And that's why you always average in. You buy in stages so you get a good average price. As long as you buy a good company at a price which is undervalued, at a strong level of support, and you do that consistently, you will make a lot of money, all right? Question number 2, should you use stop losses for investing? Of course not. Never ever use a stop loss for investing. Difference in trading. Now, in trading, you always use stop losses. Why? Because short-term trading, you may buy a company that's not fundamentally good or it's not undervalued, right? So you got to use protection. It's kind of like a one-night stand. You got to use protection because you don't know the person really well. You're going in because they look hot, right? Based on the technicals. But when you invest in a company, it's like getting married. Okay, so when you invest in a company, you're buying a fundamentally good business that's undervalued. and you're buying it when it's underpriced. So if it goes even lower, you don't sell. That's stupid to sell. You buy more shares, okay? Because it's a good business. If it's a good business, it will go higher eventually. So you just got to be patient and not sell out, all right? You know, think about it this way. Let's imagine if you own an apartment and it's a great apartment, it's a beautiful apartment, and you bought it for $500,000, for example, all right? And your neighbor comes to you the next day and says, hey, you know what? I'm willing to buy your apartment for $400,000. He quotes you lower on it. Do you panic and say, oh my God, he's quoting me $400,000. I'm going to sell him my apartment for $400,000? Or are you going to give him the middle finger and offer to buy his apartment for $400,000? Get my point? So my point is that when you buy a good business, it's like buying a nice apartment. You know what it's worth. And if the market quotes you lower, don't be stupid and sell it to the market. In fact, take advantage of it and buy more shares from the market if you have some more cash left, right? But please don't sell it, right? Because if it's a good apartment, it will grow in value, right? Next question, what kind of leverage on positions would you use to avoid liquidation on value investing? Well, in general, I discourage using leverage. I discourage using margin when investing. Always invest with cash, and only invest with cash that you do not need to use for at least the next 3 to 5 years. The trouble is when you invest with borrowed money, it psychologically changes you, right? And if the market suddenly drops 10, 20, 30%, you're going to shit your pants. You're going to panic, you're going to get emotional, you're going to sell at the worst time, or worse off, you may be forced to sell from the broker because of a margin call. So I suggest you never buy on borrowed money, never buy on margin, invest only with cash, all right? In trading, you can use margin because for trading, you have a stop loss to get you out, and you only risk a small percentage of your net liquidation value of your capital, not of your leverage funds, okay? Next question from Thomas, right? Hello, Adam. How do you exit a wrong investment, and how do you figure out you made a mistake in picking that company? All right. So again, you're talking about investment, different from trading, okay? In trading, you enter a trade, you got a stop loss, it hits a stop loss, you get out. Very simple. Now, investing, how do you know you made a mistake? Really simple. Again, you know, for me, before I invest in a company, it has to meet 7 criteria to be a great company, right? For example, my first criteria is the company must have predictability in earnings. It must have consistent growth in sales, profits, and cash flow. It must have consistent rising profit margins, for example, right? One of my other steps is that a company must have a sustainable competitive advantage. It must have an economic moat. So I've got all these rules before I buy a company for investment. Now, the moment the company fails these rules, the moment the fundamentals change, you gotta sell. You gotta get out, right? So the question would be, how do you exit? Very simple. Just click sell, right? Just click sell, right? But remember that you always want to sell on a temporary high, okay? So even if the stock's on a downtrend, right? A downtrend goes like that, right? Downtrends like that, okay? So you never want to sell at the bottom of a downtrend, okay? So even if it's a lousy company, you say I want to get out, wait for a rally, a temporary rally, and at least sell at the high of the downtrend, sell here before it goes back lower, right? And don't sell here because after a plunge, it always tends to rally back up and then plunge back down again if it's a lousy company. Now, I've also got quite a number of questions on fundamental analysis, which is related to investing. So let me just answer some of them. First question is from Analyze. Analyze, is that your name? Analyze, interesting name. Okay. So hi Adam, there's talk about inflation and upcoming increasing interest rates. How does this affect stock market in general and industry in specifics? Okay. So the first question would be inflation. How does inflation affect stocks? Now remember that when you buy stocks, you're buying businesses, you're buying companies. So will inflation hurt the companies or will they not hurt the companies? It depends. It depends, right? So the thing is this. Inflation causes the increase in costs. So imagine if you own a business, with inflation, you have to pay higher wages to your employees. You have to pay higher raw material costs, higher capital expenditure costs. So your costs rise, correct? Now, but if your business, if the company has pricing power, it's able to raise prices to pass on the cost to consumers, then the company will not be adversely affected by inflation. Okay, so what kind of companies are able to raise their prices easily and pass the cost to consumers? The answer is companies that have pricing power, that have a brand monopoly, that are in a strong competitive position. For example, Nike. For example, McDonald's. For example, Ferrari. So for example, these kind of Estee Lauder, right? So for these kind of companies, they're able to raise prices. People are still willing to pay more, and they can pass on the cost to consumers, right? So notice that all the companies I invest in, they tend to have pricing power, so that inflation doesn't affect them adversely. Okay. But if you invest in companies that are, for example, industrial companies, property development companies, auto manufacturers, because they're in a very commoditized industry, they are not able to raise prices as easily. So as their costs rise and they can't raise their price because they lose market share, they will get squeezed from inflation. So avoid, especially companies in industrials, all right? Companies in manufacturing, those will not do well in inflation. Companies with high capital expenditures, okay? The next question would be increasing interest rates. So what kind of companies would benefit from rising interest rates and a steeper yield curve? Generally banks, insurance companies, and companies like CME Group, which runs the futures and options exchange, because that improves the trading of treasury securities. All right. Okay, next question from Lars. Hi Adam, want to ask you, what's the best metric for a company's future? PE ratio, PEG ratio, free cash flow, price to book, discounted cash flow. Okay, so one thing to understand is that these methods are not used to predict a company's future. These methods are used to value a company, to tell whether a company is cheap or expensive. So what's the best way to value a company? Well, it depends on the kind of company. So there are 5 main methods I use to value a company's stock, and I teach it in the Value Momentum Investing course. So generally, I like to use a discounted cash flow method, or discounted free cash flow method. And we use this method generally on companies that have consistently increasing free cash flow or cash from operations. And normally these are the kind of companies I invest in most of the time, okay? But sometimes there are companies where, for example, insurance companies and commodity companies. So for these kind of companies, their cash flow tends to be inconsistent. So for these companies, you have to use a discounted net income method, all right? And then there are some kind of stocks like banks and REITs where you have to use a price to book ratio or price to NAV ratio. And there are some companies that are not making money yet. For example, like Teladoc or like Fastly, if I'm not wrong, I think they're still not profitable yet. So for these companies with no profits, no cash flow, you have to value them using a price to sales growth ratio, which is price to sales ratio divided by the projected annual growth of the company, sales growth of the company, right? And of course, the simplest way to value, which is very limited, is to look at the price to earnings ratio, PE ratio, and then you compare it to historical average PE. But that has a lot of limitations because PE ratio does not take into account the growth of the earnings, and earnings itself can be creatively manipulated. So it's better to use a cash flow method. You can also use a PEG ratio, which is a PE ratio versus earnings growth rate. Okay, so the next question would be, hi Adam, for a relatively young investor with limited amount of capital, is it better to be less diversified to build up your wealth than to diversify, or is it always better to have a diversified portfolio? All right, so again, remember, there are many kinds of diversification. You have got concentrated diversification where you only have, for example, 10 companies. or 20 companies, and you have got broad diversification. For example, people like Peter Lynch, he used to have like 200 to 300 stocks at one time. And you have people like Ray Dalio, where they are huge they diversify across many asset classes. They invest in stocks, in bonds, in cryptocurrencies, in gold, in oil, very diversified. So it really depends, right? So my suggestion is that if you are relatively young with smaller capital, you may want to focus more on growth companies, secular growth companies, and some speculative growth companies. And you could, have probably about 10 companies, right? 10 great companies to focus on. And of course, as you grow older, like me, and you've got more capital, you could then further diversify not just into growth companies, but also into cyclical companies, defensive companies, high dividend companies, and REITs, and so on and so forth. Okay? All right, next question would be, mind to explain your basis calculation for your discounted cash flow in intrinsic value calculator. I saw you use operating cash flow for most US stocks, free cash flow for Chinese stocks, while TSM you pick net income. All right. So which one do I use? It depends. Generally, I use what is most consistent. All right. So generally, I like to use cash from operations. Generally, that's the case. Okay. However, if the cash from operations is a lot higher than the net income by more than a factor of 1.5 times, then I prefer to use free cash flow, which is the cash from operations minus capex. Now, having said that, you have to ensure that the free cash flow is increasing consistently. The trouble with many companies is that their capex is inconsistent. So some years they've got more capex, some years they've got less capex. So that creates a very inconsistent growth in free cash flow. So for those cases, then you can't use free cash flow because it doesn't make sense projecting something that is not consistent, right? Then you got to use net income as a way to project. So which one I use depends on which one is more consistent. Basically, that's the bottom line, okay? Arjan Singh, can you explain why you use different discount rates for different companies? Okay, very simple. How do I determine the discount rate I use to discount future cash flow to present value in the intrinsic value calculator? For example, in my valuation of Tesla, notice that I use a discount rate of 8.4%. So why 8.4%? Well, if you look at this table over here, you can see that the discount rate I use is based on the capital asset pricing model, which is the risk-free rate plus beta multiplied by the market risk premium. And for the risk-free rate and the market risk premium, I'm taking a 10-year average. Okay, so it all depends on the beta of the stock. The higher the beta, the higher the discount rate. So what's the beta of Tesla? Let's take a look. If you go to Finviz, you can see for Tesla, the beta is 1.88. So what is beta? Beta tells you how volatile the stock is, and 1.88 means that this stock is 88% more volatile than the S&P 500. So based on a beta of 1.88, you can see the beta, anything more than 1.6, we use a discount rate of 8.4%. Hence, we use 8.4% discount rate for Tesla. Next, we've got a couple of questions on options trading strategies. Okay, and they're all three questions are pretty much related. So I'm going to tackle all three at one go, right? So first question would be, how do I short the market with options without spread and time decay? So good question, because the problem is if you want to short the market by buying a put option itself, then you've got time decay, right? Every day you're losing extrinsic value on the put. So the best way to do it is if you want to short a stock or short the market, you buy a put at the current price and you sell another put at the target price. And that's what we call a bear put spread. And so when you learn about it, again, you can check out my YouTube videos to get an idea. And of course, in the options trading course, we go in depth in how to execute bear put spreads. Another method you could use is to use a bearish synthetic spread, which means if you want to short a stock what you do is you buy a put and sell a call at the same strike price with the same expiration date. Because what happens is that when you sell a call, the profit you get from the call, the premium, is used to buy the put. So you have got a zero cost trade with no time decay, and you are short 100 shares of the stock. So let me just draw that out for you. So basically, again, there are two ways to short a stock using options with no time decay. The first method is a bear put spread. So for example, you see the stock going down like that, and it's making a rally, and you think it's going to go down. What you do is you buy a put here, you buy a put at the money, right? And you sell a put at your target price. So you buy a put here, you sell a put here. So by selling the put option, you collect some premium to pay or finance part of the put over here. We call this a bear put spread. So by doing this, you don't have the effect of time working against you. In fact, the trade's profit is maximized at expiration. So that is one method you can use, right? Of course, this is taught in detail in our options trading course. The second method is to use what is known as a bearish synthetic spread. So the way to do it is, again, if you see something going down, right, it makes a rally on a downtrend, you want to short this stock, what you do is you buy a put at the money, and you simultaneously sell a call at the same strike price with the same expiration date. Because what happens is when you sell a call, the premium you collect is used to pay for the premium of buying a put. So it cancels off, so there's no premium, right? And there's no time decay. So we call this a bearish synthetic spread. Now, if you want to trade a stock long, you can use the same method except the opposite, right? So that answers the second question, which is what's the best way to trade with less capital and not have all your buying power held up for certain positions. So again, if you're going long, what could you do? If you're going long on a stock, again, there are two ways to do it. So let's imagine you've got this stock, right, that is going up like that, wave up, wave down, wave up, wave down, and you are going to catch the wave up here. You want to go long. So the first thing you could do is to use a bull call spread. So a bull call spread means you buy a call at the money, right? And then you sell a call at the target price. So when you sell a call, you collect premium, and this premium is used to offset or finance part of this call. So you get a lower cost trade, number one. Number two, you do not get the effect of time decay because the trade maximizes profit at expiration. We call this a bull call spread. Again, this is taught in the options trading course. The other thing you could do is you could use a bullish synthetic spread. All right, so if you're betting on the price going up, what you do is you buy a call and you sell a put at the same strike price with the same expiration date. Because when you sell a put, you collect premium, which is used to finance the cost of buying the call. So in this way, you've got a free trade in a way, right? You don't have to pay any debit to enter the trade, and you're long 100 shares of stock, right? So if you'd like to get an idea how this is done, you can check out my YouTube channel. Just go on to my options trading strategies playlist, and you can see there are 51 videos you can watch to get the basics on options trading strategy. So one of the videos you can watch would be this video, which is how to buy 100 shares at 1/4 the cost. And this is using the bullish synthetic spread. And if you check out this video, which is how do professionals trade options for consistent profits, part 1 and part 2, this is about using the bull call spread. So check out these videos to give you an idea, and then if you want to learn the entire strategy, enroll in our options trading courses. So the third question would be, what's my opinion on leaps? Leaps are basically options with long-term expiries, right? And you buy them deep in the money, and so that replicates owning 100 shares. Now, personally, I don't like leaps. Why? Because again, it's very expensive and you're subjected to the loss of extrinsic value. You're losing time value every single day. So if you want to go long on a stock for the long term, my suggestion is just buy the underlying shares. That's the best, right? But if you want to use options, then again, best thing to do is to use a diagonal spread, which means you buy a deep in the money call and you sell out of the money calls with a 30-day expiry to finance the long dated call. We call that the poor man's covered call or the diagonal spread. So that's a cheaper way of doing it. Or the second method is to use a bullish synthetic spread, which is simply you just buy a call and sell a put at the same strike price. And that is equivalent to owning 100 shares of stock, okay? And again, only do this for fundamentally good companies. All right, so let me go on to the miscellaneous questions. Hi Adam, I really like your teaching. Thank you very much. I'd like to join your investment classes. I'm new to the stock market. I'd like to find out what's the difference between the online courses and the Wealth Academy live seminars, right? Okay, so just go to piranhaprofits.com and you can see all our courses there. Basically, we've got what we call on-demand courses. On-demand courses are pre-recorded courses. You can watch anytime. You get a lifetime access to the courses and to our Telegram chat group community. We also have got master classes. For the master classes, it is live. I teach it live about 4 times a year. And we also have got live options courses as well, right? So the difference is that one is live and one is pre-recorded, but the content is more or less the same. So if you're someone who doesn't have the discipline to watch the videos on your own, you need it live, then you can take the master class. But if you have the discipline to watch the videos on your own, all the content is there, you can take the on-demand courses. Okay, Vishnu. Hey Adam, I've been following you for more than a year. Blah, blah, blah. Hats off to you. Thank you very much. Is investing way better than trading? Okay, so there's no better or worse. There's no better or worse. Again, like I said, investing is like getting married. Trading is like a one-night stand. Which is better? Well, it depends, right? So there are pros and cons to both approaches. So for me, I invest and trade at the same time. So when it comes to investing, the thing about investing is that your win rate should be 100%. I repeat, when you invest, you win 100% of the time because you only buy very fundamentally good businesses. You buy them when they're undervalued. You hold them for the medium to long term. You will always make money on the portfolio of great companies, right? But for trading, your win rate would be about 50 to 60% win rate, right? Because when you enter a trade, half the time it's going to hit your stop loss, the other half is going to hit your profit target. But the thing is that when it hits your profit target, you make more money than what you lose on your losing trades. So in the end, you make money, and that's trading, right? Now, having said that, using certain option strategies like credit spreads and the bull put spread extreme strategy, my trading methods have a win rate of 80 to 90% win rate. And again, that's what we teach in our courses. So they are both great, right? Do I have Indian companies in my portfolio? No, I don't. I've only got mainly US companies as well as China companies, okay? Jack, I see you have a buy and hold portfolio and options portfolio. Which one gives you better returns on the long run? Should someone consider dividing their investment capital 50-50 stocks or options? It depends on you. So for me, roughly 80% of my portfolio is in holding the underlying companies, about 80%, and 20% I use for options trading. All right. Okay, ML is asking, what's my greatest investing mistake in your investing career? What have you learned from it? Well, let me show you. In fact, I posted about this mistake I made on my Facebook page. So here's the mistake. Now, this was back in 2012 when I first bought Facebook shares. And you can see I did a screenshot from my order, right? So I bought Facebook shares at the price of $19.19. Okay? So what's the mistake? The mistake is this. I bought it at $19.19 and I sold it at $60. So at that time, I thought I was smart because I made 3 times my money, right? Bought at $19, sold at $60. I'm a genius. But in actual fact, I was a goddamn idiot. I was a bloody stupid idiot, right? Why? Because if I had held on to it all the way to now, I would have made like 16 times my money, right? So one of the lessons I learned, one of the biggest mistakes I've made over the years is jumping in and out of good companies. So what I've learned is that when you buy a great company with a high growth rate, there's a monopoly like Facebook and Amazon and Alphabet and Microsoft, you never sell. You never sell it. You hold it for decades and it compounds your wealth to millions, right? But people don't do that because people want instant gratification. The moment they buy, it goes up a bit, they want to sell, take the profit, hopefully buy it back. And by jumping in and out, yes, you make money, but you make a lot less money than if you were to just hold a good company over the long run. So that's the lesson I've learned. And that's why for me nowadays, when I buy a great company that's still growing with good fundamentals, I never sell it. I'm going to hold it and let it compound. And the only time I'm going to sell it is if I need the cash to buy something. If I don't need the cash to buy something, I'll just leave it in there and let it compound my wealth. Okay, the last question, and I think we've covered more than 30 questions, right? Not a question, but can you do mindset videos? Not just investing, but in a more general sense, motivation, how to manage negative emotions, cope with difficulties, handle problems. Absolutely yes, I can do that. In fact, I've done that. On my YouTube channel, click on my playlist, and under playlist, click on Patterns of Excellence. So this is a set of videos I've created. You can see they're altogether 17 videos on the psychology of success, where I cover everything from how I achieve success using NLP, how to take charge of your mind and results, how to take calculated risks, a secret to lifelong happiness. Some of you make a lot of money, but you're not happy or depressed, right? Happiness is a state of mind. You can program yourself to be happy. And in this video, I talk about how to be happy, right? How to let your emotions serve you and not enslave you. How to master your emotional states. The ultimate success formula. And even for those of you who are in a marriage, you want to bring your marriage to the next level, check out this video of mine, Secrets of a Successful Marriage, right? So everything is covered there. Check it out. Subscribe to my channel. Go through all the videos because there are hundreds of videos that can enrich your life. So, hope you enjoyed it. May the markets be with you. And subscribe for the next available video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.